Welcome to the Deep Dive. Today, we're really tearing into what might be the biggest semiconductor story this quarter. Intel's Q3 2025 earnings. I mean, the market just went wild, right? Stock soared. The headlines basically screamed, Intel's back, turnaround complete.
Oh, absolutely. It was a huge moment for sentiment. Intel blew past Wall Street estimates. You had, $13.7 billion in revenue, and the non-GAAP EPS, they just crushed it.
Yep.
$0.23 when everyone was looking for, maybe a cent or two, basically break even.
Yes, psychologically massive.
Yeah.
Snap that six-quarter losing streak.
Exactly.
Okay, so that sounds amazing on paper. And the stock price, well, it certainly reflected that. But, here on the Deep Dive, we always look for the story behind the story. Is there a catch? Is this spectacular success maybe masking something else?
There is definitely a catch, and it really comes down to the difference between, let's say, financial brilliance and core operational health. Yes, they reported this massive GAAP net income, $4.1 billion, huge number.
Yeah.
But the vast, vast majority of that, it wasn't from selling more chips better. It came from strategic, non-operational stuff. Financial moves.
Okay, so they pulled off a clever financial play to boost confidence.
Brilliantly executed from a financial perspective. But if you look at the actual engine room, the part of Intel that makes and sells the core products, the success there is, it's more muted. And the struggles, they're still very, very real.
Right. Maybe we need an analogy here. Because $4.1 billion in profit, that grabs headlines. It makes it seem like, poof, all the problems are solved.
Okay, think of it like this. Imagine Intel was running a huge personal deficit every month. Instead of just, say, getting a raise or cutting daily spending the core operational fix, they decided to sell their yacht and maybe a vacation home.
Ah, okay.
So for that quarter, boom, their bank account looks fantastic. They can say, look how profitable we are. But the fundamental issue, the day-to-day income versus expenses, hasn't changed nearly as much as that big number suggests.
That makes perfect sense. Okay, let's unpack that GAAP number then. $4.1 billion, a 124% jump year over year. For folks maybe not deep in accounting, what's the key difference between GAAP and non-GAAP, and why is it so critical here?
Sure. So GAAP, generally accepted accounting principles, that's the standard rule book. It includes everything. One-time windfalls, big restructuring costs, asset sales, you name it.
The whole kitchen sink.
Pretty much. Now, non-GAAP,
Yep.
which companies often prefer to highlight, tries to strip out those unusual non-recurring things. The yacht sale, in our analogy, it's supposed to give you a clearer picture of the ongoing core business profitability.
And so what was that core non-GAAP number for Intel this quarter?
Much smaller. It was $1.0 billion, or 0.23 cents per share.
Okay, so the gap between the flashy GAAP number and the core non-GAAP number is $3.1 billion.
Exactly. $3.1 billion. That's 3 times bigger than the underlying operational profit itself. That difference, that's the yacht and the vacation home.
So where did that $3.1 billion actually come from? What specific assets did Intel sell?
It was mainly 2 big moves they finalized this quarter. They got about $5.2 billion in cash total. The biggest piece was completing the Otera deal, selling off a majority stake in that business.
Right, the FPGA in it.
Correct. And they also sold off another chunk of their stake in Mobileye. These were very deliberate, strategic moves to bring in cash right now, and frankly, to help shape that profitability story during a tough turnaround phase.
Okay, that clarifies the financial engineering part, but let's be fair. Even looking just at the operational side, the non-GAAP numbers, there were some genuine improvements, weren't there? Signs of better discipline.
Oh, absolutely. You have to give them credit there. They are definitely executing on cost control. Non-GAAP gross margin saw a really significant recovery. It jumped to 40.0%.
Wow, from what?
From a pretty dismal 18.0% just a year ago. That's a massive swing.
Okay, a 40% gross margin? That doesn't just happen. How did they pull that off operationally?
2 main things, really. First, just aggressive cost cutting. They were pretty ruthless. R&D spending, marketing, general admin costs, MG&A, they fell hard. We're talking 17% to 20% down year over year. Headcount cuts, portfolio streamlining. And second, they did focus the product mix. They prioritized shipping their newer, higher-margin CPUs, things like Arrow Lake and Lunar Lake in the PC segment. Those chips just naturally make more profit each.
Okay, but I have to ask this. When a company like Intel, whose whole game is innovation and leading-edge manufacturing, cuts R&D by nearly 20%, isn't that risky? Aren't they potentially sacrificing the future for today's margin, especially when they're trying so hard to catch up with processes like Intel 18A?
That's the million-dollar question, isn't it? Management would tell you they're cutting fat, not muscle. that they're focusing the spending where it matters most, like on that critical 18A node, their next big thing in manufacturing.
But it's still a cut.
It is. And the depth of those cuts means they have basically zero margin for error now. If they stumble on executing 18A, if that schedule slips again, then yeah, these cost savings could look like a really bad trade-off down the line. You save money but lost the race.
Understood. Okay, shifting gears slightly, let's talk about the cash pile. Asset sales plus outside money. They've really beefed up the balance sheet, haven't they? Built a war chest, as some called it.
The balance sheet is, yeah, the undeniable win here, no question. They pulled in something like $20 billion in cash overall from various deals. They ended Q3 with a staggering $30.9 billion in cash and short-term investments.
Wow.
That kind of money gives them huge flexibility, and they need it for this incredibly expensive global foundry build-out they're undertaking.
Where did all that cash come from specifically?
It was a really interesting mix. You had $5.7 billion land from the U.S. government, part of that big Cheap PS and Science Act funding.
Right.
Then $2.0 billion came in from SoftBank. And, crucially, there's another $5.0 billion expected in Q4 from NVIDIA, an equity investment.
Okay, let's pause on the CAPS Act money for a second. That's more than just cash, isn't it? It changes Intel's strategic position, maybe even its identity.
Oh, absolutely. When the U.S. government puts in that kind of capital and effectively becomes a major stakeholder, maybe around 10% ownership implied, Intel becomes something like a national champion.
A national champion.
Yeah, it creates this powerful strategic moat. Suddenly, Intel isn't just another chip company. It's a government-backed, secure, domestic alternative to competitors like TSMC. And TSMC, while dominant, is in Taiwan, which has geopolitical sensitivities, right?
Right.
So this backing kind of de-risks Intel's massive turnaround effort. It provides political cover and financial support, even if they struggle commercially for a bit longer.
And the NVIDIA deal, that's huge, too. Not just the $5 billion, but the collaboration agreement that goes with it.
Super significant. I mean, think about it. NVIDIA is the king of AI right now. For them to invest $5 billion signals, they see Intel as necessary, maybe even vital, for the broader ecosystem's health. And they didn't just write a check.
No, they agreed to work together.
Exactly. They're going to jointly develop custom PC and data center products, stuff that integrates Intel's CPUs with NVIDIA's GPUs and accelerators using NVLink. It's not just a friendly gesture, it ties Intel directly into the massive growth wave of AI computing. And Intel desperately needs that connection, given their own struggles in AI.
Okay, so we've got this picture of brilliant financial maneuvering, strategic backing, a loaded balance sheet. Now let's pivot to the operational side, the nuts and bolts, because this is where it feels like, well, like a house divided. The profitable old guard funding the struggling new ventures.
That's a perfect description. You're basically looking at 3 different Intels under one roof, each with a completely different financial reality playing out.
Okay, let's start with the one carrying the load. The Client Computing Group, CCG. The PC chip business.
The resilient core.
Right.
Yeah, CCG performed solidly, pretty much as expected. They did $8.5 billion in revenue, up 5% year over year. And importantly, it was very profitable, $2.7 billion in operating income. That's a healthy 31.6% margin. This part of Intel is doing well, riding some big market trends.
What trends are those? Just people buying more laptops again?
Partly, yeah. The overall PC market has finally returned to year-over-year growth after a slump. That helps everyone. But there are 2 bigger things for Intel. First, the looming Windows 11 refresh cycle.
Windows 10 end of life.
Exactly. October 2025. That forces businesses, big customers, to upgrade their fleets. Huge built-in demand. And second, Intel's been really successful positioning itself for this whole AI PC wave. They're on track, they say, to ship over 100 million AI-capable PCs by the end of 2025. They're playing known market shifts really well here.
Okay, so CCG is the reliable engine. Now, let's flip the coin. The Data Center and AI Group, DCAI. This is where the numbers get, well, frankly, kind of shocking. Because this segment should be booming, right? It's the heart of the AI revolution.
Yeah.
But Intel's performance.
Stagnant is almost generous. DCAI revenue was $4.1 billion. That was down 1% year over year.
Down in this market.
Down 1%. Just let that sink in. The demand for servers, for AI accelerators, for high-performance compute is absolutely exploding globally, and Intel's data center group is flat to slightly down.
Okay, we need context here. Put that $4.1 billion against their main competitor in this space.
The contrast is staggering. NVIDIA, same reporting period, their data center revenue wasn't $4 billion, it was $30.8 billion.
Wait, $30.8 billion?
$30.8 billion, and it grew 112% year over year.
So NVIDIA's data center business is more than 7 times bigger than Intel's.
And it's doubling every year.
7 times larger. And doubling, it just paints this incredibly stark picture of the competitive gap. Now, Intel management talked about supply constraints, saying they couldn't make enough Xeon server CPUs to meet demand.
Okay, maybe some truth there, but the sheer scale of that gap suggests something more fundamental is wrong. It points to issues with product competitiveness, especially in the AI accelerator space where NVIDIA dominates. Intel is just struggling to stay relevant in the market that's basically defining the next era of tech.
Wow, okay. And then there's the third piece, the big, expensive, high-stakes gamble, Intel Foundry, building chips for others.
This is the big drain right now, isn't it?
A massive drain. Intel Foundry reported revenue of $4.2 billion for the quarter. Sounds okay until you see the operating result.
Yeah.
A loss of $2.3 billion.
Ouch. A $2.3 billion loss on $4.2 billion revenue.
Yeah, and here's a really critical footnote. Almost all of that $4.2 billion in revenue, it's internal. It's Intel selling chips to its own other divisions like CCG.
So they haven't really landed the big external customers yet.
Not in any significant volume, no. They're basically subsidizing this massive build-out internally right now.
Yeah.
And they're trying to catch up to the undisputed world champion.
TSMC, who, by the way, reported $33.1 billion in revenue in their last quarter, growing over 40% year over year, and doing it with phenomenal 50.6% operating margin.
50% margin, that's incredible.
And crucially, TSMC said that the advanced stuff, the 7nm and below nodes that Intel is desperately trying to match with 18A, that accounted for nearly 74% of their revenue, they dominate where it matters most. So yeah, the foundry is essential for Intel's future vision, but right now, it's a multi-billion-dollar bet, consuming cash and generating huge losses.
So you've got the profitable past and present CCG, basically bankrolling these two really tough, really expensive fights for the future. DCAI against NVIDIA and the foundry against TSMC. What does this setup mean for the immediate road ahead? Because Intel's guidance for Q4 for the next quarter seemed to pour some cold water on the Q3 celebration.
It definitely felt like a bit of a brake check, yeah. For Q4, Intel forecast a sequential decline, revenue midpoint dropping to $13.3 billion, down from Q3's $13.7 billion. But the real pinch is in profitability.
Margins are coming down sharply.
Exactly. Non-GAAP gross margin is forecast to fall pretty hard, down to 36.5% from that 40.0% they just hit in Q3. And the non-GAAP EPS guidance, just 0.8 cents. That's a steep drop from the $1.23 they just posted. The Q3 party seems like it might be short-lived.
Okay, why the sharp pullback? What's driving that?
It's a few operational realities kind of converging. First, you lose the high-margin Altera revenue because that's deconsolidated now. Second, you have higher costs as they start ramping up these brand-new leading-edge manufacturing nodes, like for Core Ultra 3 on Intel 18A. Those are expensive to get going.
Makes sense.
And third, and this is critical, they specifically called out strategic capacity prioritization.
Which usually means they have to choose who doesn't get chips, right? Double-edged sword.
Absolutely. They said they're shifting limited manufacturing capacity towards the DCAI server products, trying to make up for some of that demand they couldn't meet. But the consequence is they have to pull back capacity from the lower-end PC chips, and that means they expect the profitable CCG segment to actually decline sequentially in Q4.
That supply constraint thing is really biting them. Management says, oh, demand is outpacing supply, which sounds good initially.
Right. Sounds like a good problem to have.
But if you consistently can't actually build the stuff people want to buy, you're just creating opportunities for your rivals, like AMD, to step in and take that share.
And the reports confirmed that. Their Q3 PC growth was apparently held back because they couldn't make enough chips, even on their older, relatively mature Intel 7 process. That points to ongoing execution problems in manufacturing, which they just cannot afford right now.
Okay, this brings us to the final big question, I think. Risk, especially with that stock price reaction. After the Q3 beat, Intel stock was trading at a really high forward price-to-earnings ratio, wasn't it?
Astronomical is maybe the word.
Yeah.
After that rally, the stock was trading at over 300 times forward earnings estimates.
300 times. For a company in a mature cyclical industry like semiconductors, that seems insane.
It is pretty wild. And what it signals is profound, really. It means the market has basically priced in perfect execution, not good execution, perfect execution of this incredibly complex multi-year turnaround plan.
Zero room for error.
Exactly. There's just no margin for error baked into that stock price. So any significant stumble, if 18A slips, if DCAI continues to stagnate, if foundry customers don't show up soon, you could see a very fast, very severe correction in the stock price, which is why, a lot of analysts are still pretty cautious despite the Q3 beat.
Okay, so let's try to synthesize this.
Mhm.
Intel pulled off a brilliant financial quarter. They used asset sales, they secured government backing, built up this huge cash reserve, got stability, got market confidence back, short term at least. But underneath, the operational picture is really divergent. You've got the steady, profitable legacy PC business, basically funding these incredibly important but currently loss-making and high-risk battles for the future in data centers and manufacturing.
That sums it up perfectly. And it leaves us and you listening with this final thought to chew on. Given that immense competitive pressure from TSMC and NVIDIA, and given the sky-high expectations baked into that 300x PE valuation, how long can Intel realistically rely on internal cost cuts and government funds? How many more quarters do they have before they absolutely must show real commercial external success in the foundry and genuinely competitive products in the data center? The market right now isn't just hoping for success, it's demanding perfection.